Parliament rejected all 8 alternative Brexit proposals in a series of indicative votes in the House of Commons last night. It comes after Theresa May reportedly told the 1922 committee she would quit as British Prime Minister if her Brexit deal goes through. According to the BBC, May is considering a third meaningful vote on Friday. Former British Foreign Minister Boris Johnson is reportedly ready to back her deal after May said she would step down. However, the DUP still won't because of the Irish backstop. Michel Perera is the Chief Investment Officer at Canaccord Genuity Wealth Management and is with me now to discuss. So just having a quick look at the chart of the pound, because we saw it move higher on the back of that report that Boris Johnson could be set to back her deal. Then it came lower after the indicative votes came to no conclusion. But look, if we look at the moves in cable since the start of the year, we're actually up 6%. So, I mean, you never would have predicted that at the turn of the year.
Well, it actually is, a lot of it is due to the rumours that have been floating and the fact that we're coming closer to the deadline, in fact, incredibly close to the deadline, and therefore people are assuming that there is going to be some sort of deal, that we're going to avoid the cliff edge. That is basically what the market is telling you. The market,
is that your expectation then?
Well, we're not. As I said before, we're not soothsayers, and therefore we can't really tell what the political process is going to throw off. But it seems to me that the market's been remarkably complacent about the risk of a hard Brexit, because at the end of the day, if you don't have a further extension from the European Union, you only have 3 choices. Back Theresa May's deal, which has been fully approved by the European Union without any changes whatsoever to it, have a hard Brexit, or cancel Brexit through revoking Article 50. That, at that stage, means that the probability of a hard Brexit is much, much higher, perhaps, than the markets are expecting.
So what's the best situation then for markets, do you think?
Well, it depends what part of the market you're expecting. Certainly, markets overall worldwide would react quite badly to a hard Brexit, because the disruptions to supply chains, the disruptions to all kinds of things happening between the UK and the EU, and potentially other parts of the world as well, is going to be seen quite negatively. And the fact that simply governments cannot agree on anything internally, let alone with other governments, is obviously quite a negative as far as the markets are concerned. So I would imagine that if we had a hard Brexit, markets worldwide would actually fall quite a bit. If we do have any kind of deal, whatever it is, then in the UK, you just have to see how that deal is going to affect different parts of different sectors. If the pound goes up because we have a soft deal, or Theresa May's deal gets approved, then obviously the domestic companies are probably going to be a better bet than the global international companies with foreign earnings. And that's where we would probably like to go more into small caps, because that's where you're more likely to find companies that are more domestically orientated.
Any sectors in particular?
Well, there's lots of services sectors. I mean, you know, the UK is very, very big on services. And in the small cap arena, you have quite a few technology companies, believe it or not. They're not the large fangs like in the US, but there's quite a lot of stuff, you know, Silicon Roundabout type thing, which are doing quite well in the UK. So there's quite a few sectors that we would go for. They're less likely to be industrials, because industrials are more likely to have activities that cross borders, and therefore they would be affected by the pound going up.
So what are you saying to your clients at the moment about how to invest in the UK?
Well, the first thing is we do prefer other parts of the world right now, because the rest of the world is the global asset allocators, the ones in Boston and other parts of the world, are actually quite standoffish as far as the UK is concerned. They don't really want to invest that much. So we see better opportunities in the US, in emerging markets, in Japan, etc. But within the UK, we find that it's a stock picker's market. It really is company against company rather than necessarily sectors. Obviously, there's always the issue that if you have a domestic rally, you look for the most domestic activities. You know, house builders, food delivery, you know, that type of thing. Those are companies that are likely to do better. But the house builders have rallied quite a lot since the beginning of the year already, because people have been anticipating that. So therefore, it becomes more of a company by company basis rather than purely a sector analysis.
And finally, this is probably a very difficult question, but I mean, the FTSE 100's done pretty well since the start of the year, along with broader global markets, which have had a pickup after that very challenging Q4 last year. Do you think we'll continue to move higher for the FTSE from here?
Between now and the end of the year, I would say yes, obviously subject to not having a massive disruption due to Brexit, but I would say that is the case. But we have to bear in mind that we may be at the beginning of a correction after the last 3 months of markets going up, and therefore it's not necessarily the time to pile into the market right now. And of course, when you look at the FTSE 100, bear in mind its sector composition. A lot of oils, a lot of banks, a lot of pharma and consumer goods, not necessarily fully representative of the UK economy.
All right, Michel, thank you so much for your time.
Yeah, thank you, Victoria.
That was Michel Perera, Chief Investment Officer at Canaccord Genuity Wealth Management. I'm Victoria Scholar, and thank you for watching IGTV.